Okay. So this is last session, last review session, and I will review first chapter 13. Let's go, chapter 13. I will review chapter 13, bond pricing and yields, and then I will review chapter 21, cost of capital, and finally I will review chapter 21, capital budgeting. So the time is 11, and let me start. Let me find one more. Yeah, okay. So just 1 second. I'm just checking. Okay, I'm recording. Okay, I'm recording. Okay. Just 1 second. Okay. I hope you can hear me and you can see the slide. Okay, and I am recording the slides. Okay, let's start this session. So first, quickly review the chapter 13, which is bond features and pricing. And we will first look at the agenda for today. First, I will show you the finance diamond and explain the bond pricing, yields, and we will solve some problems and a quick wrap up. Okay, this is the finance diamond. As you remember, we have savers and borrowers, we have financial institutions and financial markets, indirect transfer and direct transfer of funds. And we already look at the financial statements, and we already define and explore the toolbox, which is present value and future value, formulas, probability, annuity, return formulas, and risk measurements. Now we will look at the bonds, which was issued by firms, corporations, and governments. So bond pricing is the value of bond depends on future cash flows, as you already read and already solved many questions regarding stock prices. It's similar as stock prices. We always look at the future cash flows of bonds in order to price the bonds. So comparable bonds can have different coupons and can have different prices. The price of the bond is sum of the present value of coupon payments and principal repayments. And present value of the bond is simply the present value of coupon payments and the present value of principal repayments. Bonds that have a face value of $100 or $1,000 can be traded at par, at premium, or at discount. So the current price of the bond can differ from the face value of the bond. Let's solve a quick question. Let's find the price. Find the price of $1,000 face value bond that pays 6% interest annually and matures after 3 years when the current discount rate is 6%. So you already familiar with the financial calculator, and you know the PMT, FV, and I variables. PMT is the payments, FV is the future value, and is the period, number of period, I is the interest rate. So the question already gives us all the components for bond pricing. So we already know the payment, which is 6%. Interest payment annually. This is important. And how can we find the payment? Payment is just 1,000 face value multiplied by 6%, which is 60. 60 is the payment per year. So every year the bond holder get paid $60. And the future value is 1,000. And number of period is 3 years. And interest rate is 6%. This is discount rate. So the current discount rate is 6%, which is 6. Don't confuse yourself. We have two different interest rates. The one is the first one is interest payment for coupon, and the other one is the discount rate of these payments. These are different. So let me just put the values. We can find the present value of bond for $60 payment per year, and the future value 1,000, and the coupon rate is, sorry, discount rate is 6%. The present value of this bond is 1,000. Why this is minus? Because this is outflow. You're paying $1,000 today, and you get paid $60 next year, the time 1, time 2, time 3, and at time 3 you already get paid $1,000. So just find the present value of these payments and find 1,000. And the final present value of the 1,000 bond that pays 6% interest and matures after 3 years when the current discount rate is 8%. Now the current discount rate is 8%, which is different than the previous example, and this is higher discount rate. Our expectation is this is at the denominator. As you remember, for discount rates, we have payments over 1 plus discount rate, right? So if the discount rate is getting higher and higher, our expectation is the present value should be smaller, right? So same, the payment is 60. How can we find this? The 6% interest payment on $1,000, and the future value is 1,000, and the number of period is 3, and the discount rate is 8%. The present value of this bond is just shy of $1,000. So discount rate, market interest rate, is different from the coupon rate. As you see, this is the coupon rate, this is the discount rate, and the discount rate is higher than the coupon rate, which is our example. The current price of the bond falls below the face value. What is the face value? Face value of the bond is this, 1,000, which means the bond is selling at a discount, because you see the face value of the bond is 1,000 and the present value of this bond is 948.46, which is the lower than 1,000. So if you want to buy this bond today and get paid principal in 3 years, and the annual payments are 60, you need to pay only $948 for today. And so the logic is simple. The bond is just trading at discount, selling at discount. Okay. All right. So similar, but the opposite logic. What if we have discount rate is lower than the interest payments? Let's say we have coupon payment 6%, but the discount rate is 4%. This is the discount rate. So you see, same payments, same future value, the number appears same, but we have now 4% discount rate. Now we have higher value for today, so we need to pay over $1,000 in order to get this bond. And in this situation, when the discount rate is lower than the coupon rate, the current price of the bond rises to above the face value. The face value is 1,000. The present value of this bond is 1,055.5. So, which means that the bond is selling at premium, right? Okay. And okay, let's move on. Next slide. So, relationship between bond prices and interest rates are inverse. If the interest rates is higher, bond prices decreases. If the interest rates is lower, getting lower and lower, we have higher bond prices. So interest rate risk is, if interest rate increases, bond prices will decline. If interest rate falls, bond prices will rise. What is the maturity concept? When interest rate changes, the current price will change, but the price of the bond with longer time, the maturity will fluctuate more than the price of the bond with the shorter time maturity. Let me explain by showing this table. So we have current interest rates. These are the different bonds. We have 2 bonds with different maturity dates. So For the first bond, we have 10-year maturity, and the second one is 20-year. So if you look at, but they are same, they're paying same coupons, same coupon rates, 8%. These bonds pays 8%, the other one is 8%. And when we calculate the present value of these coupons, we find for the 10-year bond, the present value of the 10-year bond is 774. And for 20-year bond, the present value of this bond is just almost 700. But if you go to, if you change the current interest rate, this is the discount rate, let's say from 12% to 5% here, you see for the 10-year bond, we find the present value is 1,232, and for 20-year bond is we have 1,374. So as you see, with the difference between the present value of the 20-year bond with the 12% discount rate and the 5% discount rate, as you see, the difference is almost 373. But this difference is here for 10-year bond is much less than 373. So the fluctuation is much lower than the higher maturity rate. Just that this table just explains the prior slide. Let's move on. So as you see, we have inverse relationship between market value of the bond and the interest rates. When interest rate is higher, we have lower market value. The relationship is inverse. Let's go. But we should know that no matter a bond is currently traded at discount or premium, the current price, the present value of the bond will approach the face value as the time approaches maturity. So we simply calculate the present value of the bond today for, let's say, 30-year bond. But if you just approaching the maturity date, let's say 5 years past, 10 years past, we only have 1 year for the maturity, you just simply approaching the face value of the bond. Don't confuse yourself. We just find the present value of 30-year bond and discounting find the discounted cash flows for the payments and the principals for 30-year. But if the maturity is just 1 year or 1 day, or if the bond matures today for 30-year maturity fund, the maturity bond, you will see the value of that bond is same as the face value, which makes sense. So when the market interest rate is fixed, the bond with higher coupon rate has higher price than the bond with lower coupon rate. Why? If you remember the calculation, the payments at the numerator and at the denominator, we have 1 plus I over a power of 1 or power of 2, depending on the time, the t. So if the numerator is getting higher, which is coupon rate, we have higher price. Sorry. Okay, so let's solve the problem and we will see what I meant. So we are considering buying 10-year 10,000 bond with a coupon rate 5% paid annually. If the discount rate is 5%, what will you be willing to pay this bond if we have discount rate 6% or 4%? So the payments for every period annually, this is important, annually, right? 50 for year 1, year 2, year 3, and year 10, we get 50 plus principal. So we basically try to calculate the present value of these values. Like for here, 50 over 1 plus I power of 1, we just calculate the present value for payment at time 2, present value of this value, and all of them, and sum them up and find the value of the bond. So this is equivalent to 50 annuity and 1,000 single sum problem. Combined, we can solve it it as such manually or using calculator. I strongly recommend you to use financial calculator because things getting ugly when you just simply use manual calculations. But in order to understand calculation, let me explain. If you look at the selected ratios and definitions PDF document that I put on the Blackboard, you will see the NUD, present value of NUD formula at the bottom. And as you see, this is the coupon payment, this is the interest rates, 1 minus 1 over 1 plus R power n. This is the formula for the present value of NUD. So you can put the values here, 50%, $50 coupon payment over R is the 5% multiplied by 1 minus 1 over 1 plus 5%, right? Over 10 for 10 years. So you will get the present value of NUD is 386.09. So present value simple sum. So you need to also, this is for payments. 50 is for payments. So you need to find $1,000 payment at time T10, right? So the cash flow 1 over R over N, this is 10, this is 1,000. So you will get the 613.91. So you should sum up them to get the total value of this bond. So you will get 1,000. Okay. So same calculation, but you can use calculator. I strongly recommend use your calculator and find the value, which is very simple. You just go to your financial calculator and find n variable, put the n, enter the n is 10, put the I, which is interest rate, is 6, payments 50, just payments, enter 50, future value is 1,000, and compute future present value, which is 926. So why we find this? Because now the interest rate is 6%. It's not 5%, right? We are using different discount rate. Okay. So what if we have 4% discount rate? Same calculation, everything is same. Only you need to change is here interest rate is 4%, and you will find the different value, right? Now you need to find, this is minus sign, outflow. You need to pay 1,081.11 in order to buy a bond which pays you $50 annually. And at the end of the 10 year, you will get 1,000 par value. And the discount rate is 4%. So the price is greater than 1,000 because the current interest rate is lower than the coupon rate, right? Let's go. And current yield, this is the different concept that we need to know. The definition of yield curve, current yield. Okay, current yield is annual interest payment divided by current price of the bond. So we know how to calculate the current price of the bond, and we already know the annual interest payments. We simply put the payments numerator and divide by the present value of the bond, and so we find current yield of this bond. So as you remember, we have $1,000 future value bond, pays 6% interest, which is $60 interest per year, and which is 3 years, N is 3, and the discount rate, the discount rate is 8, or I is 8, and we have already calculated that the current price of this bond is 948.46. So this is the current price of the bond. This is the payments, interest payments. We find current yields. However, a disadvantage of the current yield is that it doesn't consider any future changes in bond price if the bond price is yield to maturity. So okay, we know that the 60 is stable for T1, T2, T3, T4, time 5 or time 7, same all the end of the 10 year or 3 year, right? But the present value of the bond changing over time. If you're calculating present value for time 0, what if you the time passed for 2 years and you will calculate the present value of the bond at time 2? It's changing, it's not stable. Okay, yield to maturity is simply discount rate, the rate which equates the cash outflow, the cost of the bond, and the present value of the future cash inflows. So simply the discount rate. So let's solve an example. Consider a bond with current price 952 and the face value 1000, which is future value. The annual coupon rate is 10%, and it matures in 3 years. The N is 3. What is the current yield of this bond? How can we calculate current yield? You remember we need to find the payments over coupon payments over current price. So the question only gives us the current price, which is 952. What is the coupon payment, which is $100. So we find 10.5% current yields, right? How can we find the yield to maturity? So we know present value, we know payments per year, we know the future value, we know the number of periods. How can we find the discount rates? The simple calculation, if you use a financial calculator, just put the numbers, enter the numbers in financial calculator and compute for the discount rate, which is I, and yield to maturity is 12%. So if the bond sells at discount, meaning the coupon rate is lower than the discount rate, the yield to maturity exceeds the current yields, right? Let's look at this chart. So if the coupon payment is 8% and yield to maturity is 8%, we find the bond price is 1000. If coupon payment is higher than the yield to maturity, which is discount rate, so we have higher bond price. If the coupon payment is lower than coupon payments or coupon rates lower than the yield to maturity, we have a lower current yields. Okay. So I highly recommend you to use the financial calculator. If you don't, you need to calculate Y value to find discount rate. This is the back end calculation when you use your financial calculator, and simply you're just solving Y given P, coupon payments, number of periods. Okay. Problem 3, consider the 5-year 1000 bond with a 2.2% yearly coupon rate and semi-annual coupons. This is extremely important. If you see this, you need to be very cautious, because now you need to calculate semi-annual coupons, which is just a 1.1%, right? You need to divide yearly coupon rate over by 2 and find the semi-annual coupons. If the bond is currently trading for a price of 963.11, what is the bond's yield to maturity? Same calculation, but it's kind of tricky because you need to use semi-annual coupon payments. Let's solve this. So present value is already given, 963.11. Future value is 1000. Number of periods, 5 years multiplied by 2. Why? Why we multiply by 2? Because this is semi-annual. How many periods do we have? So per year, we have two semi-annual parts. So for 10 years, we have 10 number of periods, right? So payments is, we need to multiply by 1.1 by 10,000, 1,000 par value, because how can we find this 1.1%? This is annual payment, annual interest rate divided by 2 due to the semi-annual payments. So by using these values like payment 11, semi-annual, 10, number of periods, future payment, a future value of the bond, and the present value of the bond, so we find the yield to maturity, discount rate. So, but this is for semi-annual rate, but the question asks you the annual number of this yield to maturity. So you just simply multiply by 2 and find the yield to maturity for annual. for annual calculation. Okay, the last question for this chapter is, what is the coupon rate of a 10-year $1,000 bond with semi-annual coupons and the current price of 10,004.53 if it has a yield to maturity of 5.5%. So same calculation, just use your financial calculator and enter the values for present value, number of periods, future value, and yield to maturity. But you need to be careful about semi-annual coupon payments, right? How can we find yield to maturity for semi-annual coupons? So you just simply divide this 5.5% by 2 and 2.75 for yield to maturity rate. And so you just compute for the payments, semi-annual payments. This is 27.8 semi-annual payments. If the question, not the if, but the question asks you the annual coupon payments, you just multiply by 2 and find the 55.6 for annual payments. So annual coupon rate is 55.6 over 1,000, which is annual coupon rate is 5.56%. So summary, when the bond price is greater than the face value, we say that the bond trades above par or at premium. When this occurs when the coupon rate is higher than yield to maturity. When the bond price is equal to face value, we say that the bond trades at par. This occurs when coupon rate yields to yield to maturity. When the bond price is less than the face value, we say that the bond trades below par or at a discount. This occurs when coupon rate less than yield to maturity. Let's go quickly next chapter, which is 21. Chapter 21, cost of capital. Okay, in this chapter we will look at the components of cost of capital, the weighted average, optimal capital structure, and we will solve some problems and quick wrap up. Okay, so cost of capital is cost of funds used to finance the purchase of assets. So what assets can corporation or purchase? Any kind of investments, property, plant, equipments. How can a company finance those investments? They can use debt, they can use preferred stocks or common stocks. So these are the cost of capital, cost of funds used to finance the purchase of assets, right? So what is the optimal capital structure? What is the optimal ways one company should go or should decide to use to finance those purchases? Should the company use debt only, or zero debt, or just common stock? What is the optimal weights, optimal value for this problem? So the best combination of firms' debt and equity financing, this is the optimal capital structure. So the big question is, what is the best combination of debt and equity? So should the company use only debt, or only common stock, preferred stock, or combination of them? At the end of the day, eventually we try to minimize the cost of capital by combining different components. This is the whole chapter explaining this concept. So the first component is cost of debt. As you remember, we have 3 components: debt, preferred stock, common stock. So all of them have different weights, can have different weights and different costs. Let's look at the cost of debt first. So the effective after-tax cost of debt represents by R_D, depends on interest rates, I, and corporate income tax, T, and the risk. For a given risk class, the after-tax cost, the cost of that is interest rate multiplied by 1 minus t, the tax rate. So if a firm's interest rate is 8.3 and the tax rate is 35%, the cost of that is just 1 minus tax rate multiplied by the interest rate. Why we have this formula, why we have this calculation? Because this is tax shield. The corporations doesn't pay taxes based on their cost of interest. So you need to extract the interest payments for cost of debt. So simply just by calculating the interest cost of debt, it can be equal to I if you doesn't take care of interest payments exclusion, but you need to exclude the interest payments in tax calculation, because as I said before, corporations doesn't pay tax based on their interest payments. So it is simply 1 minus t, which is 35%. The corporation only pay 65% of this value, which is 5.395%. Okay. And factors affecting cost of debt, flotation cost, which is paid for the investor bankers or investment firms, short-term versus long-term. It also affects the debt. The short-term debts or long-term debts, usually long-term debts, much higher than the short-term ones. And the leverage, the percentage of the debt over total assets, if the corporation has full of 100% debt, which is equals to their the leverage is debt over equity. If the corporation has 100% leverage ratio, which equals debt equals equity, or more than that, that increase the default risk of this corporation, right? They're just getting more debt and debt, but they have a very small amount of equity. So the next item is cost of preferred stock. The price of the preferred stock depends on the dividend and required rate of return to the investors. So this is cost of debt, cost of preferred stock. How can we calculate that? We look at the dividend of preferred stock and price of the stock, right? Preferred stock. So the dividend for preferred stock price, and we just divide dividend over price, stock price, preferred stock price. We find the cost of preferred stock. Simple calculation. How can we calculate the common stock, the cost of common stock? There are two possible ways. If the company doesn't pay dividends, we should go capital asset pricing model. Or if the company pays dividend, you can use dividend pricing model in order to get the cost of common stock, or you can use two models and compare them, and maybe you can use a combination of them. Anyway, you have two options in order to calculate the cost of common stock. And let's look at the first way. You can use capital asset pricing model, which equals risk-free rate plus beta of the company, beta of the common stock. This is market return minus risk-free rate, right? And you will find the cost of common stock. So for example, a firm has a beta 1.12, which is beta, and the current S&P 500 return is 7%, RM is 7%, RF is 3%. The cost of equity is simply just put the value 3% here plus beta multiplied by the difference between RM and RF. You get 7.48% for the cost of common stock by using capital asset pricing model. The second option, you can use dividend payments and growth rate and the price of the common stock and find the cost of common equity. How can we find this formula? It's easy. Just we manipulate our formula. If you if you put G here with a minus sign, you will get our cost of common equity minus G, which is equal to dividend payment multiplied by 1 plus G over P. And if you manipulate the P, write the P left side and write the RE minus G as a denominator of here, you will remember the formulation of the price of the common stock, right? Which is dividend multiplied by 1 plus G, which is the dividend payment at time T1 over cost of common stock minus G. So just a simple manipulation and we find our E value. So a quick question. So a firm common stock is paying a dividend of 1.15 and the dividend will grow at 5% annually. The firm's current market price is 27. What is the cost of equity of this firm? So simply, same calculation, same formula. We have here the dividend plus dividend multiplied by 1 plus growth rate over the price of the common stock plus the growth rate, which gives us 9.47 for the cost of common equity, right? And this tells managers that firm's cost of capital equals 4.47 dividend yield, which is here, and plus 5% growth rate. So the cost of common stock is 9.47. Okay, let's go. Next slide. The small trick here is that if there is a flotation cost, you need to subtract this flotation cost from the stock price, and you will get higher cost of common equity. What is flotation cost? You need to pay some cost to the underwriter, like an investment firm, the issue stock or the floated the stock. So yeah, if you incur that cost, you will get higher cost of common stock. Okay, next slide. Okay, we are getting end. So at the end of the day, we need to calculate the cost of capital, and this is weighted average cost of capital calculation. We have cost of debt, cost of preferred stock, cost of common stock, and these are the weights. And weight 1 plus weight 2 plus weight 3 should equal to 100%, or should equal to 100%. So the goal is to minimize the weighted average cost of capital that maximize the value of the shareholder interest, the firm. So we try to find some weights that minimize the R value. So we are trying to minimize cost of capital. So let's look at this table. I only show here cost of debt and cost of common equity. I'm not showing you W2 and RP, preferred stock. Let's assume the company doesn't have any preferred stock. The company only has debt, some amount of debt, and some amount of common stock. So just ignore W2 and RP in order to, just for simplicity, and I'm showing you only W1, which is the proportion of debt, and common equity, proportion of common equity, right? So the cost of debt and cost of equity. So how can we find weighted average cost of capital? Just you multiply by W1 with RD, W3 with RE, and find 10%. How can we find this? 0 multiplied by 4, which is 0, 100% multiplied by 10, which is 10, and just sum them up and you'll find 10%, right? Similar calculations and same logic. you will find these values. So, okay, what is the big picture? The big picture is company has some equity and debt, and we need to find the best combination, the optimal weight of equity and debt, and in order to find the minimum cost of capital. So we are using some amount of equity, some amount of debt, and find the minimum value of this combination. Okay. So if the firm is entirely financed by the equity, the weighted average cost of capital equals the cost of equity. Here is, and when the firm substitutes the cheap debt financing for equity financing, the weighted average cost of capital begins to decrease, right? And however, as the firm's leverage level increases, the firm becomes riskier, and eventually the firm cost of capital will rise. Okay. And there exists an optimal point or range at which the firm's cost of capital is lowest. You may ask why we're just using equity. If the company use only debt, you see, this is the lowest cost, just 4%, 4%, 4%. This is the debt equity ratio, right? And why company just goes equity and doesn't simply use debt? The simple answer is, if the company only use debt, the default risk is getting higher and higher, and the cost of capital quickly jump a higher level if the corporation only use debt. So it's better to use some amount of equity in order to reduce the default risk of this company. That's the simple question, simple answer of this question. Okay, let's solve a quick problem. The expected return on target equity is 11.5%, and the firm has a yield to be treated on its debt is 6%. Debt accounts for 18% and equity for 82% of the target's total market value. What is if its tax rate is 35%? What is WACC? Simple calculation. We have weights for the debt and the cost of debt. We need to take care of the tax, because there's a tax shield, and the company doesn't pay tax on interest payments, interest cost. So we need to take care of this, and we have weights, and we have cost of equity. Simple calculation. What is the debt ratio? We just put the 80% for the debt ratio. The cost of debt is 6%. Tax rate is corporation tax rate is 35%. Plus, what is the weight of equity, which is 82%? What is the cost of equity? 11.5%. We find weighted average cost of capital, which is 10.1%. This is the just summary of this chapter. So another problem, and I think you can solve this problem on your own, and yeah, just simply this problem. Okay, let's solve this. Simply the problem, we have preferred stocks, debt, and common stocks. You need to find weights first. So just you sum up the debt and common stock and preferred stock, and you will find 67 billion, and you'll find the weights, and you will use these weights here in the WACC calculation. In the second step, you need to find the cost of equity, cost of preferred stock, cost of debt. So cost of equity is here computed by using capital as a pricing model. This is risk-free rate. This is beta, and this is risk premium. And you will find cost of equity by using capital as a pricing model. And this is 32% for the preferred stock. How can we find the preferred stock? Cost of preferred stock. This is the dividend for cost of preferred stock. This is the price of preferred stock. So dividend over price. This is the cost of preferred stock plus that percent weight. This is the 20%, 85% weight for the debt. How can we calculate RD. RD is just the interest rate multiplied by 1 minus tax rate. Tax rate is 35%. So if you sum them up, you will get 8.83%, which is back value which is the cost of capital of this company. So we calculate the cost of capital, and we try to find answers of 3 questions. The first one is what are the components of the cost of capital? Why is cost of capital important? And how can a financial manager find the optimal capital structure of a firm? So this summarizes chapter 21. And let's go chapter 22, capital budgeting. Okay. And capital budgeting is process of selecting long-term investments. It involves the allocation of the large amount of resources, like replacement of equipment, expansion of the existing product line, development of product lines, or intangible assets. Okay, let me. So net present value is the present value of cash inflows minus cash outflows. So at the end of the day, for the investment decision, you need to calculate the present value of all benefits and all the costs, and just subtract cost from benefits, and you will find net present value. If the net present value is higher than 0, you should accept the project. If the net present value is less than 0, you should reject the project. Just the cost and benefit analysis, right? So ranking well, if you have mutually exclusive projects, pick the one with the highest NPV, net present value. It's a quick problem. We just calculate the net present value by looking at the outflow and inflows. I will not read the question. Just pause the video and read the question, and I just jump to the solution. So this is the inflow today, and this is the outflow for a couple of years, and you will find the present value of your outflows. This is inflow, and you just subtract your inflow minus outflow, and you will find 75.43 is net present value, which is positive. You should accept the project. Okay. Take it or leave it to decision. A fertilizer company can create a new environment-friendly fertilizer at a large savings over the company's existing fertilizers. The fertilizer will regard a new factory that can be built at a cost of the $85.6 million. Estimated running a return on the new fertilizer will be $28 million in the first year and the last 4 years. So if the company cost of capital 10%, should the company undertake the investment? So yeah, we look at the 28 million cash flows, cash inflows for this investment, and you need to invest $81.6 million right now, today 0, and you'll get this amount of money. So simply just this is the discount the cash flows, and with the rate of, I guess, 10, right? It was 10. Yeah, cost of capital is 10, and find the net present value. So this is the time 0 outflow, negative sign, and this is the inflow, time 1, time 2, time 3, time 4. This is the cost of capital and discount rate, discount cash flow for the first year, second year, third year, and fourth year, and you will find the net present value, which is 7.15 million, and it's positive, except the project. So we have, as you see, if you have cost of capital 2, 4, 6, 10, so 8, 10, 12, 14, if the cost of capital is 14%, the net present value is 0 for this project. If the cost of capital is 2%, it goes to, I think, between 30 and 20 million positive. If the cost of capital is, let's say, more than 14%, NPV is getting negative. So cost of capital is extremely important when a company decide whether to take the investment or not, right? So the IRR is another important concept for deciding investing for the investments. So IRR is just, as you see, 14% is just make the just a break-even point, leave it or take it point, right? If the cost of capital is 14%, the net present value is 0, which is equals the benefits and costs, the present value of benefits and present value of costs for this project. So we call it IRR. Let's jump to the IRR concept. So okay, yeah, okay, I will jump to the concept just after 2 slides. So using the NPV rule, NPV of the project, the NPV depends on cost of capital, as I explained here, as you see. The NPV profile graphs the NPV over a range of discount rates based on the data, and NPV is positive only when the discount rates are less than 40%. If the discount rate is less than 40%, NPV is positive. If the cost of capital higher than 40%, the NPV is negative. So that is explaining the concept. You can read this. I don't want to find it. I don't want to explain it, but yeah, how can we find the cash flows? This is just simple accounting calculation. I assume you already know the the EBIT, depreciation, taxable income or net income concepts. So for year 1, we calculate net income based on the EBIT, earnings before interest tax, and you take into consideration depreciation of installation expenses, removal expenses, all these values, and you will find net income. And then based on net income, you should add the depreciation installation expense, 1,000, and minus 5,000, right? And you will find, let's see, 11 minus 6. Yeah, so yeah, if you just sum them up, and you will find 10,960 for the year 1 cash flow. This is just a simple cash flow calculation. For the second and third and fourth year, you will find around 15 or 16,000, and for the 5th year, 17,360. Okay, after you find the cash flow for each year, next step, you discount cash flows by using cost of capital, right? So for the time 0, this is the outflow of 60,000. For the time 1, time 1, 3, 2, 3, 4, and 5, and the NPV, net present value of this project, is 1,764.4. So which is positive. You should take the investment. You should invest this project. Take this. Yeah, you should take the investment. You should invest this project. Anyway, internal rate of return is another concept that we should be aware of. IRR is the rate which equates the present value of cash inflows and outflows. Let's go to the slide. So if the 14%, if you have cost of capital equals 14%, NPV is 0. This is IRR. Okay. So what is the decision? This criterion is if the IRR is greater than cost of capital, accept the investment. If the IRR is less than the cost of capital, reject the investment. So ranking rule, when you have mutually exclusive projects, you pick the one with the highest IRR, internal rate of return. Mutually exclusive means that acceptance of one automatically excludes the acceptance of other. Okay, let's solve the problem, and it helps us to understand the concept. Okay, we have a few slides more. Okay, back to fertilizer problem. Suppose that the cost of capital for this company is RE 10%. Cost of capital is 10%. Okay. Cost of capital 10%. You can hear me. Okay. And calculate IRR. Do you accept or reject the project? So cash flow is today you're paying $81.6 million, and you get paid 28 for time 1, 2, 3, 4, and simply we need to find what is the IRR value that equates the NPV 0. That's it. So if the IRR is greater than 10%, yes, accept the project. Okay, so what we find that IRR is 14%, right? IRR is 14%. What is the cost of capital? 10%. So internal rate of return is greater than cost of capital. That means we should accept the project. Okay, this is the same concept that just explained the calculation. So you have NPV in order to calculate IRR, right? So this is IRR value. This is cash flow for time 1 and time through time n, and you just sum them up and multiply by the cash outflow of today. So NPV should be 0 because in order to calculate the IRR, we says that we accept that NPV is 0. NPV is 0. You put the cash flows here, and you simply try to find IRR values. Same thing, you know, the NPV is 0. When you put the minus C here, NPV is 0, you find C equals the summation here, and you're looking for R, which is IRR. You shouldn't calculate manually, which is tedious. Just use your financial calculator. It's much convenient, right? So it's more convenient. So problem 3. Assume the firm has opportunity to invest in a project which will give cash flows of 500, 200, 400, 700. Cash outflow is 1200 today. What is the IRR? So yeah, simply just get your financial calculator and write the cash flow 0 is 12 minus 12. It's important, minus 12. Cash flow for time 1, 2, 3, 4. And compute IRR, which is 16.87. Okay. So, okay, we need to compare 2 projects based on their cash flows. So if your discount rate is 10%, what are the NPVs of 2 projects? What are the IRRs of 2 projects? Let's calculate this. So for the first one, cost of capital is 10%, and we calculate based on 10% cost of capital, and we find 9 NPV, 9.11 NPV for the project A, and 21.69 for the second project. Okay, and based on this calculation, the greater is better, and you just choose the 21, the project with the highest NPV, which is project B. But if you look at the IRR, for the project A, IRR is 17.82, and for project B, IRR is 16.88, which is conflicts that the idea of if it is higher, this should be higher. The IRR for this project should be higher than the project B, but it's just opposite. So let's look at this way. So NPVA equals NPV. Let's equalize net present value for project A and project B, which is we're saying which is equates to NPV calculations. We find the IRR is 14.74. If the IRR is 14.74 for these 2 projects has 0 NPV, right? So yeah, we should be very cautious when we compare the IRRs and NPVs. Okay. Okay. let's go the last slide. What's going on? Okay. So we finished all the slides, all the course concepts and contents, and we have a quiz today, and you will have a final exam based on only 3 chapters, chapter 13, 21, 22. And I wish you all the best, and I think I don't have any questions for this session. Thank you for your attention. See you next time.